Hello, everybody, and welcome back to another episode of the Rogue Agent Answers. My name is the Rogue Agent. Some people call me David Lewis, and every week I answer one of the many life insurance related questions that I've received from clients, from email subscribers on the daily email list, questions floated to me from across the interwebs, in the comments sections, which I know you're not supposed to read, or just interactions that I've had with people in real life over the past 20 years, which is a long time. And some of these questions I just scribbled down on scrap pieces of paper. Some of these are stuff I've written down on my phone. Some of it is on Post-it notes scattered all over the office. And every week I answer one of those questions. So if you'd like to ask your question, drop them in the comments section or join my email list for more life insurance tips and advice at monogenics.com. monegenics.com. And now for this week's question. How much does my life insurance actually cost? What am I paying for, and how can I know what the company is charging me? So this is kind of a tricky question. It depends on the policy. It depends on the policy that you have. For term life insurance, this is pretty simple. You're going to look at the cost per $1,000 worth of insurance. They're going to publish this in the illustration or in the policy, depending on the carrier. Some of them are really good about it, and they just, it's really easy to find. They're not trying to hide it or anything. But generally speaking, term insurance is fairly easy to figure out. Cost per $1,000, and you know that because it's the premium. Essentially, the premium cost is going to be pretty close to what your actual cost. Not in all cases, but pretty close to what you're actually paying for the death benefit for the insurance. And the death benefit is the insurance. There's no cash value. There is a cash reserve, but you don't get it. The insurance company keeps it. So with whole life insurance, it's what you're getting is a bundled product. So they don't break out the costs. You can kind of reverse engineer those costs. What you'd have to do is you'd have to remove the interest charges, dividend credits, the premiums, and whatever the prior year's cash values are, and whatever you'd be left over with would be the annual charge for that. In other words, you have to reverse engineer the thing. It can be done. It's basically running a little bit of math in an Excel spreadsheet. Not difficult if you know what you're doing, but it's not going to be broken out for you in a policy illustration. They're not going to come out and say like, oh, it costs $2 per thousand or whatever. So most people kind of default to just saying like, oh, the premium. Like if it's $10,000 and I get $1 million in whole life death benefit, it must cost me $10,000 a year. Well, not really, because part of that $10,000 is going into cash value. So if you pay a $10,000 premium and you get $8,000 back in cash value or $7,000 back in cash value in the first year, then that first year you'd say, well, I'm missing, $3,000 or $2,000 or whatever. That must be what that costs for the year for that $1 million. And, yes and no. Insurance companies are going to bunch the costs up in the first couple of years of the policy. So it's not evenly spread out. So you can say, yeah, in the first year it's that, but that's not going to be your cost for subsequent years. So in the second year, you'd kind of have to do the same thing. You'd have to go and just kind of isolate the premiums going in, take out the cash value from the previous year, the premiums going in, and then, whatever's before interest gets added and all this stuff, what is left over if you removed all the other stuff. So each year you'd have to do that. And that's kind of the process of figuring out that. What I had mentioned before is, you have to kind of reverse engineer that. So it's not very simple to figure out what the cost is on a whole life policy. Most of the time you're not analyzing it that way, though. I don't want to try to minimize it. But you're not usually looking at cost in a whole life policy that way. Usually what you're looking for in a whole life policy is what's the net return on cash surrender value. And then usually people are comparing it to something else, like if the cost if the net return on a whole life policy is 3%, you might compare it to other things that might earn 3%. That's kind of how a lot of people do it. The way I look at it is not really either one of those. It's more like I'm just putting premium into my policy. I'm getting a certain amount of death benefit. I want to put as much premium as I can into my policy. And over time, the costs are going to be whatever they're going to be. I don't worry too much about the cost, because the way I look at it is that your policy, you can look in a whole life policy and they'll give you what's called a net payment index or cost index. that gives you a relative idea of how much that policy is going to be costing. But it's not, the way I look at it is all the premiums I put in there are pre-funded. It's pre-funding a future benefit, either cash value or death benefit. So the net after dividends and cash value is coming back and so forth, the net is going to be zero. I'm not paying in more than what I'm getting back. I'm never paying more in premiums on my policies. I'm never paying more in premiums than what the insurance company is ultimately giving back. So you can say, well, don't you want to look at the cost and, maybe you could get a better deal somewhere else? From where? Like nobody else is selling insurance except insurance companies. Maybe I could get a better, quote unquote, better deal from another insurance company. But the other way, again, the way that I'm looking at it, I'm not looking at it that way, because I might be able to go shopping and find a cheaper, theoretically, let's say I can find a cheaper cost somewhere else to some other company. But then now I have to figure, well, it's a cheaper cost, but is the company's financials just as good? I already know what the top 5 mutual carriers are in the United States, and they're all comparable to each other in price in terms of premiums. They're not that far off. Some of them are, there's some variance in there, but they're not too far off from one another. So you're getting pretty close on each one in terms of premium. Some of them do beat each other out on cash value on the back end and so forth, but it's pretty close. All things considered, it's pretty close. So you can kind of look at relative performance on each carrier's policy and say, well, I might get this back on this company, and I might get back this much on this. You're not comparing like hundreds and hundreds of companies. You're comparing like 4 or 5 companies. So if I wanted, so if I was going to be comparing something, I would be just looking at a handful of companies. If it was a bigger market, maybe I would do a little bit more. I mean, if somebody were to say, well, I really want to know the cost, we'd fine. Let's reverse engineer the cost, and you can see what the costs are in a whole life policy. It'd give you the total, right? Not just cost of insurance, but the total mortality and expense charges, all, like everything combined, because you still can't really break it out. You can reverse engineer the cost, but you can't really separate out the difference between mortality and other expenses. So you're getting operational expenses in there, agent commissions included, and cost to run the business and so on, and in addition to the mortality charges. Now, on a universal life, it's a combination of term and a cash value account. And so what they're going to do is, like term insurance, they're going to break out the charges for you. What I found is that they don't give you all of the charges. They tell you what all the mortality charges, and they break everything out. You could still reverse engineer a UL product and see some, what I consider to be kind of hidden charges. But, they're pretty good about breaking out the charges so you can see. If you just want to see mortality charges, they'll break those out for you so you can see those. If you want to see, and some IUL policies have charge-funded multipliers, you can see what the various charges are for the things that they're charging you money for. Then you can have them print off the agent can have them print off a supplemental report, and it'll show you, all the charges for stuff like that, and they'll break it out for you. And then I found that there's other charges, like operational charges that they're not including in there. But again, if you want to reverse engineer the whole thing, you can see what the totality of those charges should be. And in both scenarios, you can also get a kind of a relative idea of how much a policy is costing you just by taking the gross crediting rate and subtracting it from the net rate that they're charging you, or that you're earning rather, on cash surrender values. And that gives you, so on a whole life, if the headline dividend interest rate is like 6%, but you're only being credited, let's say 4%, that there's an implied charge of 2%, that the spread is 2% in there. So it gives you kind of a relative idea of like how expensive that is compared to maybe other assets. Like, a life insurance policy, you would expect to be if it's whole life, you're paying a lot for guarantees, and it's insurance. So you would expect to see, an expense there, and sometimes a big expense there. But like I said before, it's essentially all pre-funded, pre-funded payments for future benefits, because once that death benefit gets triggered, all of that money is coming back to the beneficiary. Well, it's coming to the beneficiary. If you somehow manage to live to age 121 or 120 in some of these contracts, then they'll cut you a check for the full death benefit amount, because the way that works is, they set a future death benefit, and then your actual death benefit is comprised of a combination of cash surrender value and pure insurance. So every year your cash value is building up, the pure insurance amount's going down until the cash value equals the death benefit at the age of maturity, or when the whole life policy endows. And usually they endow. Some of them will still endow at age 100, and then they just carry it out to 120. Others endow at age 120. So it just kind of depends on the contract. So you can kind of get an idea of when you're paying this money in. It's like, yes, you're paying these charges, mortality, and everything is going into this. It's going to the insurance company, going to the insurance company. All that money is going to running the cost of running the business, but ultimately is going to be paid in the death benefit, right? So if you've paid in over a lifetime, you've paid in $250,000, but you're getting back $3 or $4 million in the death benefit, and that's what it ends up being. Let's say when you die, then there was a charge there, but then that money is essentially making its way back to your beneficiaries through the death benefit. That's how I think about it, and that's how a lot of people in the insurance business think about it. Because insurance company, they charge you all that money, but they have to pay that back to you, or not to you, but they have to pay that back to your beneficiaries, and then some. So they have to make sure that all those mortality charges, operational charges, all the money that you gave them that didn't immediately come back to you as cash value, all of the charges, every single charge that you gave them, that you paid to them, they have to earn a return on those charges sufficient to then return to you back the death benefit amount. So it's in a certain sense, it's different than it's very different than what you see on let's say a mutual fund, where or some other investment, like where you're putting money in, and let's say you put in $1 million into an investment. It's $1 million, and then they subtract out whatever charges for the investment management fees are. And then whatever's left over is going to be credited with whatever interest or whatever gains if it's interest based, then its interest gets added back, or they're just charging you a certain management fee that comes off of your gain in the fund, in the mutual fund, and then whatever's left over after that is what you have left over. Whereas with insurance, the cash value part of it is kind of the cash value part of it is the net present value of the future death benefit, which is always higher. So it's that future benefit that people discount. Everybody discounts the death benefit until they die. That big death benefit in the future is what's holding all of those future charges. You can kind of think of it that way. It's this huge, in a sense, to you, it's an invisible bucket, because you never get to spend that money unless, there's maybe a small handful of times if you have a chronic illness or terminal illness or something, you could advance the death benefit, or when you die. Other than that, those are being held in this huge future invisible bucket, so to speak, that when you die, then that money just comes all the way back to their beneficiaries, and they're getting all that money back. Anyway, that's how I think about insurance charges. Yes, you can see it. There's a cost there. I personally don't get too bent out of shape over it. You do want to watch the charges. You don't want to, there is a point at which they do matter. It's just I don't get too bent out of shape with it, because there's a handful of companies that I'm doing business with in terms of mutual companies, and then stock companies. You're usually just, if you're buying from a stock company, usually if you're being smart, at least in my opinion, if you're being smart about it, you're just buying term insurance, and not going too far into the permanent side on that side, for reasons I won't discuss in this one. It's already getting a little long in the tooth. But that's my answer on the insurance charges and how to figure them out and what you're actually paying for. Anyway, I hope this helps, and I will see you in next week with another question. Thanks. Okay, that's it for this week's question. If you'd like to add your question to the list, just drop them in the comment section or send me an email. And if you want more life insurance tips and advice, just head on over to monogenics.com, MONEGENIX.com, and sign up for my daily email list.